If you crawl on our last video, we talked specifically about the ability to better understand our AR to AP relationship. And what that information gave us was that we had a 2.5 spread or delta between our AP to AR relationship, meaning that we pay our AP 2.5 times as fast as we do our AR. So money is leaving our account 2.5 times faster than our AR. What we did here was we went back and we looked at 2019 financials, and we said, these are the numbers from 2019 on $1.2 million in income, and we made about $200,000 in EBITDA. Remember, EBITDA is a better cash representation than net profit because you don't want things like depreciation or amortization to impact this, because really what we're trying to do is come up with a working capital amount. So how much cash do we need to operate? This is a simple and easy administrative task where you go through and just pull your end bank accounts from your working capital checking account, and you just do a running average for every year. Of course, you would have to normalize this amount if you have any sort of overdraws or checks being bounced, and that would require you to go back and kind of adjust these amounts. So if you had a $10,000 check bounce here, you need to add that back into this amount in order to make sure that this is 65, which is going to adjust your average at the end of the year. Now, when you go ahead and you go run these trailing 12 months from 2019, this comes out to be $100,000. So that historical number is helpful, but remember, most companies do not know why they keep the amount they keep in their checking account. So you can't just use this number to base what your new benchmark is going to be. So what we did here was the AP was about $40,000, if you remember. And it just so happens that if you take a 2.5, and you multiply it by the 40,000, you get $100,000. And you would look at these two numbers to correlate them. Now, it just so happens these numbers are the same, so we don't have to do any difference, but let's say this number was 80,000. We could safely say that our spread is right in the middle, so our new benchmark is 90,000. But that's not what we're doing here, because we know that it equals exactly that. And so we're going to keep this 100. And what's nice about that, which is what makes this very scalable, is that now what we're able to do is we can say, okay, we needed $100,000 in our bank account in order to make $200,000 of EBITDA. So if in 2020 we're doing our pro forma, we're going to have a great year because it's just, COVID didn't impact us, which would be very rare, and we're going to make double the EBITDA projection. Well, this becomes really easy to adjust, right? Because now all you have to do, you doubled your EBITDA. Now you just need to double your working capital from 100 to 200, and you have a new benchmark to work with. So what this does is it makes it really easy to be scalable, and you don't have to go back through the process that I've been talking about, that most business owners would want to do this once, and that's it. And that's how you do it. You reverse engineer the numbers, and then you come up with a correlation between cash in your business and what they generate to the working capital needs, which should be pretty reflective because you will have a working relationship with your revenue and your EBITDA to your working capital requirements. And that'll be dependent on your particular business. So that won't work for every business. You can't do the same multiplier, but once you do this calculation here, matched with your AP-AR relationship, all of a sudden you have a very good benchmark to work off of, which is the $100,000.